last few weeks, two of the risks that we used to highlight from equity markets perspective manifested themselves. First, the second wave of infection hit India, and second, the continuation of benign monetary policy all over the world was brought into question because of the developments in the bond market. So, while we continue to be constructive on the equity markets from a medium term perspective on the back of strong recovery in corporate earnings, we believe that the next few weeks and months will be full of volatility. The second wave of infections that we are witnessing today is unlikely to be met with national lockdown like we saw last year. So, while there will be local restrictions and the fragile businesses might get impacted, we do not expect any durable impact on the economy. Market sentiment, of course, will get impacted from time to time because of the news flow, and that will lead to increased volatility. But we do not also expect any durable impact on the markets from this second wave. The upcoming quarterly reporting season is expected to demonstrate continuation of strong corporate earnings growth recovery. The absolute numbers for the quarter, of course, are likely to look very good on a low base of last year. In our opinion, commodities and banking and financial services are expected to dominate the news flow about earnings. It's astonishing that in a year when Indian economy contracted, corporate earnings growth is expected to be low double digits for the year as a whole. We have maintained for some time now that we expect mid caps and small caps to outperform large caps, particularly on the back of underperformance in 2018 and 2019. We have already seen that has played out over the last 9 to 12 months. We expect this trend to continue for some more time, given that the economic recovery is likely to be more broad-based. We are overweight on sectors which are more levered to economic recovery. So if you look at our portfolios, you will find that we are overweight on industrials, we are overweight on cement, and we are overweight selectively on banking and financial services. Also, in the funds with the appropriate mandates, we have tried to increase the proportion of mid caps and small caps. As mentioned earlier, we are constructive on the Indian equities from a medium to long term perspective because of the ongoing corporate earnings recovery. Therefore, investors who are underweight on Indian equities should try to fix it. As mentioned earlier, we do expect markets to be more volatile as compared to last 10 to 12 months. Therefore, investors may want to spread out their investment over a period of time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.